This is the High Voltage Business Builders Podcast, daily intelligence for serious e-commerce portfolio builders across Amazon, TikTok Shop, Shopify, Walmart, and every channel that moves the needle. Neil Twa and his team, all day, every day since 2012. Let's get into it.
The landscape of third-party Amazon selling is undergoing a seismic shift, one that demands immediate attention from every portfolio operator. In just 15 months, the active seller count on Amazon plummeted from 584,000 to a mere 500,000. That's an 84,000 seller exodus, a clear market signal of increasing operational friction and diminishing margins for the unprepared. This isn't a minor adjustment. It's a consolidation event, a culling of the herd where only the most sophisticated operators will not just survive, but thrive. Consider this. Fewer than 8,000 sellers now command half of Amazon's entire third-party gross merchandise volume. This stratification isn't accidental. It's the direct consequence of Amazon's strategic recalibration, specifically through its fee structure. In a single month, we observed 4 major fee changes: the DD+7 payment delay, a 3.5% fuel surcharge, ad costs now deducted directly from proceeds, and significant FBA fee increases. For businesses operating on tight 15–20% net margins, these changes can erode profitability by 3 to 5 percentage points overnight. This isn't just about higher costs. It's about increased working capital requirements, reduced cash flow velocity, and a heightened barrier to entry. For the astute portfolio builder, the question isn't whether these changes impact your brand assets, but how you will strategically reposition to leverage this market consolidation for superior returns. This Amazon fee squeeze is not merely an operational challenge. It is a strategic filter designed to separate opportunistic resellers from robust, operator-led brand assets. The 84,000 sellers who exited weren't building sellable businesses. They were chasing arbitrage opportunities with insufficient capital and strategic depth. The core insight here is that Amazon is actively incentivizing professionalization. By increasing the cost of doing business, particularly for lower volume or less efficient operations, they are effectively clearing the playing field for brands that can absorb these costs through superior product-market fit, brand equity, and operational efficiency. For a portfolio builder, this translates directly into an opportunity to acquire or scale brand assets with higher intrinsic value and stronger competitive moats. The DD+7 payment delay, for instance, extends the cash conversion cycle, demanding more robust working capital management. This immediately disadvantages undercapitalized ventures. The FBA fee increases, particularly for oversized items or long-term storage, push operators to optimize inventory velocity and SKU profitability. The 3.5% fuel surcharge, while seemingly minor, compounds across millions in GMV, impacting the bottom line significantly. This environment favors brands with diversified revenue streams, strong direct-to-consumer channels, and a deep understanding of unit economics. The strategic imperative is clear. View these fee changes not as a burden, but as a catalyst for market consolidation that will ultimately enhance the value and defensibility of well-managed brand assets within your portfolio.
Consider Apex Gear, a composite brand asset in the outdoor recreation niche, specializing in premium, mid to high-ticket camping equipment. Unlike the 84,000 sellers who exited, Apex Gear anticipated margin compression. Their average product price point is $120, with a 30% gross margin. The recent FBA fee increases, particularly for their larger tent and backpack SKUs, added an average of $2.50 per unit in fulfillment costs. The 3.5% fuel surcharge added another $4.20 per unit. Combined with increased ad costs and the D+7 payment delay, their net operating margin on Amazon was projected to drop from 18% to 12%. Instead of absorbing this, Apex Gear implemented a multi-pronged strategy. First, they optimized their FBA inventory, reducing slow-moving SKUs by 15% and increasing inventory turns from 3.5x to 5x annually, directly mitigating long-term storage fees. Second, they invested an additional $50,000 in a direct-to-consumer DTC channel build-out, driving 25% of their sales through their own website within 12 months, where net margins are 35%. Third, they negotiated improved supplier terms, securing an additional 2% discount on COGS for a 10% volume increase, offsetting a significant portion of the fee hikes. This strategic pivot not only stabilized their net margins at 16%, but also diversified their revenue streams, increasing their overall brand asset valuation by an estimated 1.5x EBITDA multiple due to reduced platform dependency. Apex Gear didn't just survive, they strategically leveraged the squeeze to build a more resilient and valuable business.
For the sophisticated portfolio builder, navigating this Amazon fee squeeze requires proactive data-driven action, not reactive cost-cutting. Here are 3 concrete moves you can implement this week to protect and enhance your brand assets. First, conduct an immediate granular profitability audit on every SKU within your Amazon catalog. Don't just look at gross margins. Factor in the new FBA fees, the 3.5% fuel surcharge, and the true cost of advertising, now deducted from proceeds. Identify your bottom 10% of SKUs by net profitability and either optimize their pricing, bundle them strategically, or liquidate them to free up capital and FBA storage. This isn't about volume, it's about profitable volume. Second, stress test your working capital requirements. With the DD+7 payment delay, your cash conversion cycle has lengthened. Calculate the precise impact on your cash flow and ensure you have adequate liquidity or credit lines to sustain operations without disruption. A 20% increase in working capital might be necessary for some businesses. Third, initiate or accelerate your direct-to-consumer (DTC) channel development. Every dollar of revenue generated outside of Amazon reduces your platform dependency and increases your brand assets exit multiple. Start with a simple landing page, capture email leads, and drive traffic through targeted campaigns. Aim to shift at least 10 to 15% of your sales volume to DTC within the next 12 months. These actions will transform the Amazon fee squeeze from a threat into a strategic advantage, fortifying your brand assets for long-term value creation. The Amazon fee squeeze is a clear indicator. The era of casual Amazon selling is over. What remains is a landscape ripe for operator-led, data-driven brand assets that understand how to navigate complexity and extract maximum value. At the High Voltage Business Builders podcast, our 13-year track record is built on guiding sophisticated investors and operators through these exact market shifts, transforming challenges into opportunities for significant portfolio growth. We don't offer passive income schemes. We partner with individuals committed to building sellable businesses designed from day one to exit at 2 to 10x multiples. This isn't a course, it's the room you've been looking for. A strategic partnership with operators who have collectively generated over $100 million in Amazon brand revenue. If you're a high-income portfolio builder seeking to add robust, defensible brand assets to your investment strategy, we invite you to explore a potential collaboration. We have limited partnership spots available to ensure we maintain our high-touch, results-oriented approach. Book a no-pressure discovery call to see if you qualify to work with Voltage. Visit voltagedm.com. This is your opportunity to leverage market consolidation, not be consumed by it. Don't just build a business, build a legacy.
That's a wrap on today's episode. If something we covered today sparked an idea or made you wonder where you actually fit in the e-commerce landscape, there's a good place to start. Head over to voltagedm.com/discover. Answer a few questions, and we'll point you toward the right path for where you are right now. We'll be back tomorrow with another edge. Until then, stay high voltage.